Well, good afternoon, everyone. This is John Meehan at Asset Strategy Consultants, and I want to welcome you to our capital markets outlook for 2021 and beyond. We're on Zoom webinar today, so you'll have the opportunity to view us and hear our discussions and see any slides that we're sharing. The webinar is scheduled to go for about an hour. And what we're going to do for Q&A is you do have the opportunity to type questions in to the Q&A module. And then what we'll do, we've allowed some time for the ability for the panel here to field questions. What I'd like to do is introduce our panel here, starting off. Tim Murray is here from Rowe Price. Tim, could you say a quick word about yourself?
Sure, John. My name is Tim Murray, Rowe Price. As John just said, what I do at Rowe Price, I'm a capital market strategist, which means that I work with our asset allocation committee and on a number of asset allocation portfolios to do tactical asset allocation research. So basically, my purview is just about everything, an inch deep, a mile wide type of a thing. So I cover a lot of asset classes, but don't generally get too deep to the security level, but have a good broad view of capital markets.
Great. Thanks much. And then Travis Carr is here with us from Western Asset Management. It's morning for him, but thanks for joining us, Travis. And could you give us a little background on yourself?
Absolutely. Thanks, John. Yeah, Travis Carr. I'm a product specialist at Western Asset. So I really cover our U.S. broad market strategies, which really consist of U.S. core plus, intermediate strategies, really working with the investment team and communicating to our clients and prospects and consultants, what we're seeing and what we're doing in our strategies and making sure that's communicated.
Great. Wonderful. Thanks for joining us. Ryan is here from WCM Investment Management. They're a global growth equity investment management firm. And Ryan, could you give us your background and role there?
Yeah, absolutely. Thanks, John. So my role at WCM is a client portfolio manager. And as you mentioned, we manage about 80 billion of equities in the global space with a growth tilt. My role is to be able to service clients and be on the investment strategy committee to discuss everything we're doing with the portfolio. So I'd say, in contrast to Tim, I'm a little bit more of a mile deep and an inch wide, rather than kind of a jack of all trades.
Great. Well, good. So we've got a good team here to discuss a lot of issues here. Hopefully we can be a mile wide and an inch deep in our discussions as well that we're going to be covering. And the first one that we wanted to talk about had to do with expectations for the economic recovery. We've got, back in November, December timeframe, news of the vaccines came out and markets reacted really strongly to, what was good news. And now we're in the rollout phase. So we want to get a sense have you discuss, what your expectations are for recovery in the coming year and beyond. And are there industries and regions that you expect to lead the way more than others as we get into this? And one of the things that I wanted to do to help us talk to this, Tim offered us a slide that we can take a look at. And if you would mind leading off, Tim, with talking about this, and then we can invite Travis and Ryan to join in on the discussion as well.
Sure, happy to lead off here. So as you can see by the charts I have here, I think the first thing to understand, and you can see this in the top chart. So what the top chart is is the dark blue is actual real GDP, year-over-year real GDP growth historically. The light blue is, so this is a weekly economic index that 3 economists at the New York Fed, Lewis, Mertens, and Stock, created, and they created it very early on in the pandemic. And the idea was we need to have kind of a real-time barometer of what year-over-year GDP growth looks like, rather than, basically waiting almost an entire 3 months before you found out what the previous quarter looked like. And this uses historical data plus a lot of high-frequency data to give you an idea of where we are in real time. And you can see that it's been pretty accurate. You look at that light blue line versus the dark blue line, it's been pretty accurate. And what it told us was that and I think this is quite remarkable. At the end of, as of January 2nd, 2021, what it says is that real GDP growth year over year for 2020 essentially was negative 1.19%. That's obviously an ugly number, but I don't think it's as nearly as ugly as what everyone would have said back in March, back in April, when the year over year was looking like something like negative 10%, which was really unprecedented. You can see on this chart that back in 2009, the worst we got to was negative 4%. So what we had was a really deep but very short recession and a really rapid bounce back from that. And I think the reason for that was, one, that we were able to see a lot of durable growth or durable goods spending pulled forward. So a lot of people, because of fiscal stimulus, even though a lot of jobs were lost, very few people were really at a disadvantage from an income standpoint. Most of the country did very well and actually was in better off situation than normal. And they were also saving more money, so they were using those funds to spend on things like we had a housing boom, we had big spending on autos, we had big spending on big ticket home items, we had a lot of home improvement spending. So it ended up that at the end of the year, we didn't really have as big of a downturn as we thought. What we really had was just a services-led and really travel, leisure, entertainment type of downturn, but pretty much everywhere else rebounded really quickly. So I think what's going to happen is you're going to see, and you can see this in the lower left-hand corner, that it's actually, even though we had one of the deepest recession, or we had the deepest recession on record, it's going to be the bounce back is going to be faster than in almost every other really deep recession. And it's actually, I would say, probably going to be ahead of economic projections at this point. Right now, I can tell you that for 2021, the consensus was negative 3.5%. And as you can see here, we think it's probably going to be closer to maybe like -1, -1.5. So we think relatively, we weren't in as bad a spot as we thought, and 2, that bounce back could be really, really strong, particularly in second quarter of 2021 as we start to reopen the economy. One interesting piece of data I think that really illustrates this well. If you look at you look at the national accounts and were to estimate how much additional income Americans had in 2020 versus 2019. Now, you would have thought it would have been negative or at best that the stimulus kind of filled the gap, but really it's probably an additional $1 trillion all told that Americans made in 2020 over and above what they made in 2019. And meanwhile, the spending was down by about $500 billion. So that tells you you've got 1.5 trillion extra in consumers' pockets going into 2021. And we all know that we're sick and tired of staying at home and not being able to travel, not being able to go to restaurants. So there's a tremendous amount of pent-up demand. So you combine those things and the outlook for 2021, it's a really strong acceleration. But then I would say beyond that, it's probably going to be relatively short-lived, probably a 12 to 18-month type of situation where 2021 is very strong, 2022 strong but not as strong, but then we go back to where we were as far as trend growth, which is essentially about 2%, 2.5% per year. Now, the one kind of fly in the ointment here at this point would be mutations, and so this is all assuming that we don't that the reopening goes as expected, and the mutations don't cause any problems, or we don't have any vaccine delays. I would say there's certainly a significant amount of uncertainty out there about that right now, maybe more so than the market really realizes.
Gotcha. Great. Yeah, fingers crossed on that development for sure. So thanks much. Travis, did you want to add a few other points to expand on that?
Sure. Yeah, I think when you look at kind of the expectations for economic recovery and looking across, different regions, I think a lot is going to depend on, how well some of these countries and regions addressed COVID initially. The success maybe they're having with the distribution of the vaccine. And again, this vaccine, as you mentioned earlier, really is a game changer. And I think the high efficacy rates really did help to kind of pull that eventual recovery forward. But that distribution is going to vary dramatically, not only in US and developed markets, but certainly in emerging markets. And so a lot of the recovery is going to depend on the timing and the success of that vaccine distribution and what percentage of the populations are really going to take that up. And I think the other thing that's going to drive much of that recovery is going to be the amount of monetary and fiscal stimulus that some of these countries have been able to deploy and will be able to deploy going forward. So you think about the different regions, and I think Asia is probably ahead of the pack as far as the eventual recovery. They obviously had to deal with the virus first. But they've been fairly successful in dealing with the COVID outbreak in most of the countries, and moving forward. Again, they should be first out of the recovery. You've seen China, posted I think the only positive GDP numbers in 2020, a little over 2%, and that's certainly going to be a big driver of the growth potential for other Asian countries, whether they're developed or emerging. I think next kind of on that list is probably the U.S. Again, we're certainly having our challenges with the pace of the virus, infections, hospitalizations. We're certainly not out of the woods by any stretch of the imagination. But I think as we continue with this vaccine rollout, and certainly the potential for more fiscal stimulus appears to be kind of on the horizon. So I think U.S. is kind of behind Asia in that path. And then I think after that, it's probably Europe. Unfortunately, Europe is dealing with some pretty severe outbreaks and mutations, as Tim mentioned. And you think about Europe, it's 19 different countries, and it's logistically very challenging to try to coordinate not only that distribution of the vaccine, but also coordinate any kind of fiscal response. It's very scattered, and you're going to see a wide range of responses and recovery in the different countries. And then you add into that, the uncertainties with this kind of skinny Brexit deal with the UK, and that's kind of another layer of uncertainty. I think, and then last kind of on the list as far as recovery, you have some of the emerging markets, especially in areas maybe like Latin America, where certainly challenging environment with the virus. And some of these countries, the reality is some of their healthcare systems certainly aren't at the same level as the US and other developed markets. So it's going to be kind of a staggered recovery depending on many of those factors. Again, we are fairly optimistic. As Tim mentioned, in the US, probably some above trend growth for the next few quarters. But certainly, I think it's going to be quite some time before global GDP is back to kind of pre-virus levels. There's been a lot of scarring in the global economy. I think it's going to take quite some time, certainly for that to heal.
Gotcha. Ryan, and with those backdrops there, how does that impact what you all see as you're looking at the sort of the pond that you're fishing in for your company ideas?
Yeah, so far there have been some really interesting insights, kind of from a market level. We're going to be approaching things more from the bottom up security level, and our portfolios are typically fairly concentrated. So things we really like to look for are tailwinds and global trends, and find a business that is squarely in the middle of those, so that they're able to benefit from the global tailwinds. So from a security perspective, I guess if we look at the COVID effect. Last year, we can kind of bucket our stocks into COVID winners and COVID losers. And I use the word losers lightly, because we still have a significant amount of confidence in their business operating opportunity. And frankly, we think that they may be the ones that are driving portfolio performance from here, on the other side of this vaccine. So as you can imagine, a portfolio winner would be anything that is allowing businesses to go direct to consumer, whether it's Mercado Libre in Latin America or Shopify, the Canadian company that's operating around the globe. We found those businesses to be extremely strong. Similarly, on the technology side, there's been a rebirth in demand for semiconductor chips, and competition is getting pretty tight there. And so companies like Taiwan Semi and ASML were really able to weather the volatility of 2020 significantly well, and come out actually probably stronger going next year. Now, when I mentioned COVID losers, obviously being healthcare, being growth investors, we have a significant overweight in areas like tech and healthcare and the consumer, and we've chosen to position ourselves in a fairly specific way. Many of our healthcare names are fairly defensive, but they are the types of businesses that, while they have a significant market share in the area where they operate, the COVID impact was definitely felt. I mean, think about companies like Alcon, which has an intraocular lens for cataract surgeries, or if you're looking at a Smith and Nephew, which is a orthopedic business that's a leader in shoulders, hips, and knee replacements. You weren't going down to your local doctor or your local hospital to get those procedures done, while everyone was concerned significantly about COVID early on in the first half of last year, and even into the end of last year. It hadn't really picked up yet. With the advent of this vaccine, we think that all of the demand, which we would really characterize as delayed, more so than destroyed, will come back for businesses like a ResMed, which is a sleep apnea business, or CSL, which is a blood plasma company that relies on walk-in donations. So from a security level, we're looking at things a little more balanced in terms of some of our COVID winners. We think have had business changes going forward, and we think they'll be able to continue the momentum. And then some of our underperformers from last year, or COVID losers, we expect to kind of turn around and really be leaders in our portfolio, in the strength that we expect as well in 2021 and beyond.
Great, good, thanks for the insight on that. And Travis, I wanted to move now into your bailiwick per se, in terms of interest rates and inflation, and given what's going on with this projected growth, hoped for growth, but also government responses in terms of Federal Reserve was zero interest rate policy, and then fiscal stimulus and deficits. What's Western thinking about in terms of interest rates in the future, and potentially inflation as well over the next few years?
Yeah, absolutely. There's, and I'd say Western may have a little bit of an out of consensus view on rates right now. I think as we, opened the year, rates did back up, and I think most of that was due to, there is some fear that rates will continue to rise. And much of that, I think, came out of the results of the runoff elections in Georgia for the Senate, and the fact that the Democrats now have a majority, albeit a very slim majority, in the Senate, as well as the House and certainly the White House. So we do believe there is more potential for fiscal spending, and you're hearing the new administration talk about a new, 1.9 trillion plan to help consumers and speed up the kind of the COVID response. We think about rates and inflation. We do believe you'll get a pickup in inflation this year. It's going to really come from two main sources. One is just the base effect, the fact that inflation was so low last year. Just the year over year change in comparison is going to show inflation rising. The other thing that could drive inflation higher this year will be the eventual reopening, certainly in the U.S. economy. As Tim mentioned, there's a lot of pent up demand, primarily for services, and you will see a pickup in that spending and potentially prices rising. But remembering that inflation has to be a persistent year over year rise in spending, nominal GDP, as well as and then therefore in prices, and we just don't see that sustained higher rise in inflation. You think about where we are today, and although growth in the near term will probably be above trend, the reality is we still have a lot of slack in the U.S. economy. We have 10 million less jobs than we today than we did back in February of 2020, and some of those sectors are going to take years to recover. So you think about that headwind. You think about the fact that we have a lot more debt, not only on corporate balance sheets, but also on government balance sheets than we did before 2020. All of those are going to be restrictive of longer term growth going forward. And we just don't see that inflationary pressure. So, our view is that we will get a pickup, this year in inflation. We think it's going to be, kind of temporary and short term. And therefore, we think rates are going to stay fairly low and fairly range bound. You've got the 10-year kind of bouncing around 110 and the 30-year about 185. Maybe that's kind of the new range right now, and we'll see what happens as far as fiscal stimulus coming out of the government. We just don't think that's going to have a meaningful impact on really that longer term, inflation trend, and therefore don't think it's going to have much of an impact on long rates. Obviously, the Fed controls the short end, but when you're talking about long rates, it's really a store of inflation. So our view is, we don't see a sustained rise and continued rise in inflation, and therefore we think rates stay fairly low and fairly range bound.
Gotcha. Okay, Tim. Yeah, you do take a look at, as you said, you're a mile wide there with your view. What's the firm thinking about rates and inflation in this?
Yeah, I would agree primarily with most of what Travis said, that we're similarly, as far as inflation is concerned, the expectation is that, we're going to see a increase in inflation in 2021, but we wouldn't expect it to be persistent. I think the important thing to understand is there's a big difference between inflation where you've got supply constraints that endure versus you have a sudden uptick in demand and inventory levels are low, so producers have to just kind of catch up. So you have a period of time where producers are catching up to inflation, but eventually they'll get there. And the good news with that also is that when producers have to catch up, that's good for earnings. So it wouldn't be as difficult a period for equities as you would otherwise think.
Okay, great. Thank you for that perspective there. Want to do next, Tim, is maybe talk about domestic equities. In terms of, in your view, what do you think is going to be, what's going to be the winners, and what are going to be more winners? The bigger winners than others as things recover. And let's see, what I want to do is next move down on your slide here. And this was the one you wanted to speak to?
Yeah. So this one and the next one, but I think the short answer is that. So, and we'll see on the next slide. We think 2021 is going to be a really good year for earnings. But it may not be as good a year for returns. And so if we go back to the prior slide, sorry, John,
Right.
and you could, if you go back to basically earnings we think are going to be very strong, but the bottom line is that much of that is already priced in. So that's really the issue here, is that you can have a really good year as far as fundamentals, but so much is already priced in, and probably from a standpoint of what works better than other areas. I think you can see it illustrated here. During 2020, there was a lot of bifurcation in markets. Growth versus value was the biggest one. You can see that growth outperformed value by 32%. That small caps, so large caps outperformed small caps by about 6.5%, and then U.S. outperformed international by 12.6%. And the bottom line is we would expect a reversal, but only a partial reversal of all of those different dynamics. So you would expect value to catch up somewhat. Rising rates certainly helps financials. Value tends to be more cyclical, so they're going to benefit. And meanwhile, you've got a lot of growth companies where valuations are just not extreme, but are elevated to the point where upside is limited, and they're going to need to kind of grow into those valuations, which means maybe more of a flat to modest increase in performance there. Whereas small versus large, same thing. Small is more cyclical, and so is going to probably do better than large, which also has a little more of a valuation headwind. And on the next page, you can see just to give you an idea of what I'm talking about for earnings, you can see how dramatic the earnings bounce back could be. And just to give you some perspective on this, so what's right now is baked into earnings estimates is that within 7 quarters, we're back to where we were at the end of fourth quarter 2019. Compare that to the global financial crisis. It took 17 quarters to get back to where we started. The tech bubble, it took 14 quarters. So that's a really, really dramatic rebound, dramatic and fast rebound. That's what's priced in the markets. That's why markets did so well despite the ugly situation last year. And so now really would expect 2021 to be more about alpha rather than beta.
Mm-hmm. And I think you had said when we were discussing things that you thought that the rally was going to be more, I'll call it cyclical in nature instead of secular, and that that's going to be a relatively short-lived phenomenon.
Yeah.
It gets back to where it was before.
Yeah, exactly. So it would liken it to what we saw in 2017, where the rally is very cyclical and that favors small caps and value and international. But what we're saying is that's not a regime. It's not a regime change. It's not a situation where that's going to be the new normal. Probably is something that lasts maybe 12 to 18 months, and then we go back to a situation where growth is relatively muted, and that's going to favor growth stocks again.
Gotcha. Very good. Well, good. Well, thanks for that. Let's see, Ryan, wanted to toss this one over to you, the move from the domestic equity to the non-US equity space. And in terms of what you're seeing, to the extent that you're able to, is developed versus EM going to be at a disadvantage, perhaps, given the backdrop that Travis alluded to, as well as just some of the more secular factors that are likely in favor of emerging markets. What are you seeing out there?
Yeah, I think what's important for WCM in a period like this is really maintaining our discipline around our time horizon. By stretching our view out to the 3, 4, 5+ year time horizon, it helps us focus much more on the business's health and its actual competitive advantage and the durability of their growth. That we'll probably touch on that too when we talk about some valuations. But when we
Mhm.
look at the world, to pick companies to invest in our concentrated portfolios, we're trying to find businesses that really have a long runway of opportunity in front of them and a growing mode trajectory. And what we've found in developed markets versus emerging markets over time, you can throw rates and GDP growth out the window. When you look at businesses, businesses tend to take best practices from other businesses. Mercado Libre in Latin America is an excellent example. They've been students of what Amazon.com has done, as well as Alibaba, and they've actually been able to dominate the Latin American region in their own business by learning from other businesses. You can look at similar opportunities within airlines. In the U.S., when Southwest Airlines first came out, it was a novel idea, low-cost airlines, no frills type of business. And you can see that happening in Europe with companies like Ryanair, or in Eastern Europe, like companies like Wizz Air. So you can see how these business models tend to get replicated. And it also works the other way. And that's something we're trying to capitalize on as well. So in emerging markets, they're much early adopters of things like mobile payments, as well as a much heavier reliance on the interconnectivity of devices. Given the fact that in the emerging market space, the infrastructure isn't really there. So they've sort of leapfrogged over infrastructure and have been early adopters of technology. And so for us, we're chasing those sort of long-term trends, right? We want to see greater increased consumption of technology, and then position ourselves in companies that will benefit from that trend. On the healthcare side, we want to really benefit from the increased consumption of healthcare, which is actually improving at a very fast rate in the emerging market space. So really, that's everything from the healthcare that you receive when you're sick, to the types of choices you make to maintain a healthy life, and that could even bleed over into the consumer space, where athleisure and athletic wear, whether it's sneakers or jumpsuits or whatever it is, not only is fashionable, but it's also functional. And there's an increased focus where there hadn't been before on that total body health. So these are some kind of larger trends that we see on a global basis that you're able to play from a developed country bias, whether you're buying Adidas or Nike, to play that athleisure and athletic wear trend, or if you're buying a company like Wuxi Biologics, which is a CDMO in China, has 80% market share in the country, as that country focuses on developing their own medicines internally. So there's a lot of investment, not only from science, but also from the government, to actually become self-sufficient in that space. And those are the types of things that we're looking for. And certainly there's macro risk, and we try to sort of separate that noise from our underlying security fundamental research. It's important, what the Chinese government is choosing to do matters. But in this case, you can actually use them as a tailwind, and that tends to be a pretty strong money making opportunity.
Good, great, good perspective there. See, I wanted to shift back to Travis here, and get taking a look a little bit more at interest rates and just generally, institutional investors, investors in general that have allocations to fixed income, with interest rates so low or negative in real terms, has the role of fixed income in a portfolio changed? And how have you and how's Western and been hearing about how investors are considering fixed income in their portfolio, and how best can you implement for them?
Yeah, absolutely. And I think, certainly you have to recognize, as you said, the low level of rates, and effectively reset your expectations of, what those returns will look like, going forward. Having said that, we don't think, the role of fixed income has really changed. You look at, investors building diversified portfolios, and fixed income is really the only asset class that has low or negative correlation to risk assets. And so having that diversification, we think matters. It's important. Limiting that drawdown risk, certainly going through a period like the first quarter in March, I think further, cements that view of having an asset class that's going to withstand, some of that volatility and that liquidity, potential. We were certainly tapped for liquidity back in March, and some of our clients, needed to make benefit payments or other, other issues they had going on, and being able to tap the fixed income part of their portfolio was really important. And so that liquidity, generating that income and providing that diversification, we think is still important. We do obviously have a world where, as you mentioned, rates are either negative on a real or even on a nominal basis, and so you have to be thoughtful about where you see those potential returns going forward. I think Western having kind of our global approach and really moving across a lot of different sectors in the fixed income market, we are able to identify pockets where we see value and even see positive real returns. Now, we don't see necessarily a ton of value or potential for returns if you look at sovereigns, especially if you look at Europe. You're looking at negative nominal yields. But then you look at spread sectors is where we think there's still potential for positive real returns, not only in the U.S. You look at areas like high yield and bank loans and structured products, so non-agency mortgages, commercial mortgage backs, sectors that have really lagged the recovery. Corporate credit has done very well, especially investment grade. Spreads have really kind of come back to beginning of 2020 levels. But that's not the case for areas like structured product, and certainly not the case for emerging markets. And I think that's where we see, I mentioned some of the challenges for near-term growth in emerging markets, but that is reflected in valuations. And that's where we see probably the best, real returns. You're looking at local currency EM bonds that are yielding, 5, 6, 7%. And in an environment that's really starved for yield, that's a pretty attractive part of the market. So we certainly still see opportunities, areas where we see return potential on a real basis, but you do have to be somewhat nimble and looking at adjusting that sector allocation not only in the U.S. but certainly globally. So there are pockets where we see value, but we anticipate this year is going to be more about spread product, as opposed to sovereigns, outperforming, and maybe a little bit of a handoff from corporate credit to areas that have underperformed, like structured and emerging markets.
Okay, great perspective. And on a related note with fixed income, to some extent, the Fed, since it's played such a significant role in helping the economy through the pandemic and instituted a number of programs to provide liquidity and intervene in the market. How is it going to be able to pare back its role going forward without necessarily, adding volatility or being sort of a negative role player in the markets?
Yeah, I think the Fed is in no hurry to exit the markets. I think they recognize the severity of the downturn we've experienced in the U.S. and globally. There was some chatter earlier this month about some Fed members potentially, discussing the fact that they may look at tapering the bond purchases later this year. Again, they're buying 120 billion in bonds every month between treasuries and agency mortgages. Other Fed members were quick to kind of squash those rumors and basically say, look, we're going to be involved and supporting the market until this recovery is well in hand. And so that's not only the case on bond buying program, but it's also the case on rates. And again, there was some market chatter that maybe the Fed's going to be forced to raise rates a little bit earlier than expected if we get this pickup in inflation and interest rates. And again, we really kind of push back on that. First of all, because we just don't see, as mentioned earlier, inflation rising materially. And the Fed has kind of renewed their focus on making sure that, inflation not only reaches their 2% target, but is above 2% for some period of time. They've adopted this flexible average inflation targeting approach.
Mhm.
And we don't know if for some period of time means 6 months, 1 year, 2 years, but it's certainly, they're going to welcome inflation rising and even above that 2% hurdle. And also the fact that, they've also kind of renewed their focus on unemployment and recognizing the disparity in the recovery between different economic sectors in the economy, and therefore want to get unemployment as low as possible. So in order to achieve those two things, inflation above 2% for some period of time and full employment, very low unemployment, we think you're looking at through probably 2023 and maybe into 2024 before the Fed actually starts to raise rates. Now, certainly the data can change and they may change that stance, but that's per their forecast, that's when they anticipate meeting those hurdles. The reality, as you mentioned, is the Fed is very involved in the market. I think their balance sheet is now over 7 trillion. And so, and that's not only just the Fed, but it's global central banks. The Bank of Japan is obviously a big owner of Japanese equities via ETFs. And I think the Fed now owns over 30% of agency mortgages. So they do have to be thoughtful about how they reduce their balance sheet over time. We think they'll take a similar approach as they did, after the crisis of first, tapering those bond purchases, and then slowly letting those assets unwind or effectively roll off their balance sheets. We don't think they initiate any active sell program to sell treasuries and mortgages, because that could certainly be disruptive to the markets, but probably naturally letting those bonds roll off and mature over time, gradually reducing their balance sheet. But I think the reality is their balance sheet is going to be larger than it was historically going forward. And we're not going back to kind of the old days. So they will have a larger balance sheet, but certainly they're going to look to reduce that over time. But as they've said, now is not the time. We're in kind of an emergency situation. So they're going to continue this accommodative policy until the recovery is certainly well in hand.
Okay. Great. Good. Yeah. It's, does it rhyme this time? Kind of like it was doing post GFC. Will it be a similar way of unwinding in the next 5 years or so? So we'll see. So I wanted to pivot pretty dramatically next and speak to Ryan, ask, China's equity market's really booming and getting much bigger. But on the other hand, in the US, there's been some delisting of Chinese companies. And so wanted to ask you, what's your view on what's happening there? Is WCM seeing, and does it even have an impact on what's going on as global investors?
Yeah, it's been something we've had to pay attention to, and certainly it's gotten investors' attention for sure. There's a handful of things that are happening with China right now. The first is an easy one. There's an effort to curtail U.S. investors in Chinese companies that support the Chinese military. That's something we've screened for a very long time, and it's never been a part of our portfolio. So that one's kind of put aside, and I think that non-national Chinese investors would probably prefer not to be supporting a foreign government's army. Secondly, there is a movement going on now to basically enforce GAAP accounting onto businesses. So forcing companies to be able to produce 3 years of financial statements, audited financial statements, upon request. And if they can't do that, then they actually will be risking being delisted. And that's just to protect the U.S. investor, or international investors, I should say, from businesses that may be frauds. And really, those businesses are kind of more small and micro, small, and mid-cap type businesses, areas where we tend to avoid anyhow. So again, it's something we're paying attention to and obviously taking note of, but it's usually not companies that even hit our screens to be interesting for our portfolios. And then kind of the third most interesting thing going on in China is the government's assertion of control over internet related businesses, which have become somewhat monopolistic over there. It was a good thing for a significant amount of time. I mean, companies like Alibaba and Tencent have done a lot of good for the Chinese economy. But China's 5-year plan really has a long-term goal of creating a consumer-based economy rather than an exporting-based economy in China. And so that's created some concerns around some of these businesses that may have gotten too big as in the eyes of the Chinese market. You also pair that with a very outspoken CEO of Alibaba, a gentleman named Jack Ma. He was going to IPO his financial company, Ant Financial, and the Chinese government said, no, we're gonna stop that. We need to look at a lot of things. So they scrapped the IPO there. Then Jack Ma basically disappeared for a few weeks and recently just sort of resurfaced. So there are, and I had alluded to the fact that the Chinese government can be a headwind and it can be a tailwind. Currently, they're putting regulations in place to allow them to control to any level. It's very vaguely written. Some of these internet companies that they deem as monopolistic. Now that could just be setting themselves up to act as a check and balance around these companies. It could, in other more extreme cases, be viewed as the Chinese government trying to take control or a piece of these businesses that are rapidly growing and becoming extremely important in Chinese life. But at the end of the day, the outcome is unknowable. It's quite wide. We sort of are of the view that this was some saber rattling at the beginning to really put Jack Ma in place, which we feel like they've effectively done. But again, that government support and government goal of creating the consumer-oriented Chinese economy that is reliant on Chinese production rather than Western or global production of goods, whether it's healthcare, fashion, or any other type of product, can be a significant tailwind for a lot of great young companies in China. And that's being really also recognized by global indices, in that the share and the percentage of China companies in the MSCI indices has risen to a level that it's never been. And you could even make a case in the long term that there might be a new way to view portfolios in terms of our asset allocation, rather than being, U.S., international, and emerging markets investors. We could be U.S., international, China, and emerging markets ex-China, just based on the size of that country and the type of economy they could really have if it begins to be sort of self-sustained on its own there. So China offers, as usual, potholes and as well as opportunities, and you just have to make sure that you understand where your companies stand and how they're viewed by that government, and how the consumers are going to react as well.
Good. Yeah, very complex, and certainly the size of China in the indices is an issue. We see some managers who do put some limits in terms of what their top allocation is to China, notwithstanding what it is in the emerging market indices. So complex issue. You certainly touched on a number of them, and thanks for the insight there. But I wanted to sort of simplify things a little bit. I'm going to risk sharing my screen again, but this next question has to do with valuations of technology stocks and stocks in general. Certainly, we alluded to the fact that there was such a big bifurcation in the market last year. So I wanted to go ahead and take a look, if I can, at this next slide here that Tim sent over for us to take a look at. And let's see if I can get this down here one more time. Okay, bear with us. And I'll do that. Yeah, so Tim, I'll get us over to this slide here, and maybe you can tell us in
Yeah.
Valuations what it's showing us.
Sure. Yeah. So what this is, there's a lot of talk about looking at where PEs are right now and comparing that, particularly for technology stocks, comparing that to the tech bubble. And the bottom line is you have to understand the context is very different, mostly because, or one very big reason is because of the level of rates. So back in the late 90s, you had interest rates closer to say 5%, where we're at 1% right now. And something you have to understand is the main alternative for most investors to equities is bonds. So the valuations of stocks has a lot to do with the valuations of bonds. And one way you can compare stock valuations to bond valuations very easily is to just flip your PE over and look at it as earnings yield. So basically E over P. And when you do that, you can compare the earnings yield of stocks to the yield to maturity of bonds, of different asset classes of bonds. And that's what we did here. And what you can see on the right side, you're looking at that earnings yield. The dark blue is the earnings yield of the S&P on the top and the global benchmark, all country world index on the bottom. And then the light blue is the triple B corporate bond yield. And so what that shows you is that uptick in the PE, which looks here as a sharp downtick in earnings yield, absolutely mirrored what was going on in bonds. So they're completely related there. So you have to, when you look at PEs relative to a past period like 1999, you have to understand the context of rates and adjust for rates. And when you do that, at least on a stock versus bond relative basis, actually stocks are right kind of in the median of what we've seen over history. And you can see that on these charts on the left. So what that dark blue on the left is just taking that earnings yield premium and subtracting out what the 3-month treasury was. And you can see that it's right about in the midpoint of what we've seen over history. And the same thing, if you look at the premium to triple B bonds, you go down to the bottom left and you'll see the same thing for all country world. So the bottom line here is that relative to bonds, stocks don't look that expensive. The implication, though, of that is that if rates were to go up, then PEs are going to come down. They're very much going to be very sensitive to the level of rates going forward. Now, for technology stocks in particular, technology stocks, if you think about it, are their earnings stream is like the income stream of a long duration bond, because their earnings are expected to be higher going forward. They're supposed to endure over a very long period of time. So they're kind of like a long duration asset. So they're even more sensitive to the level of interest rates. So that's why you've seen technology stocks rally a bit more. That combined with the fact that their business models were just simply perfectly, for the most part, a lot of their business models were perfectly suited to the COVID dynamic, where we're working from home and we're shopping from home. Not only that, but you have to think about the fact that there's really three big disruptive trends that have driven technology stocks over the past decade and will continue to going forward. Those trends are: one, the shift from offline retail to online retail; two, the shift from broadcast media, over-the-air terrestrial media, to digital media, and the advertising spend shift that goes along with that. And then finally, the shift to the cloud, the shift from on-site enterprise spending to both software and infrastructure cloud spending. And all three of those trends got accelerated by COVID, right? So these were things that were moving along at a pretty steady pace And suddenly, because of COVID, they got accelerated by maybe 3 or 4 years, just right there in one 3-month period, essentially. So what you have to understand about technology stocks is that, yes, I think we would say their valuations are definitely elevated at this point, and that limits the upside going forward. But for those companies that have a dominant market share position, and generally when you're thinking of the big ones, the FANGs, the top 5 in the S&P 500 that everyone talks about, they have dominant market share in their industry. The total addressable market of that industry can continue to take share, so it's going to continue to grow. They're still very much in their infancy. So all of those stocks, we think, because they're winners and if they maintain that winner position, are going to be able to grow into those elevated valuations. Where you get into trouble is when you own a company that is priced like a winner and priced like it's in an industry that is going to, in fact, grow into a massive total addressable market, and either one of those two things turns out not to be true. And there's a lot of stocks that fit that description right now, particularly in the small and mid cap, and we're wary of that, and we're being very selective in our portfolios about that. So what I would say about technology stocks is the valuations are elevated. Some deserve it, some don't. And you have to be very careful from here. Technology probably isn't going to have a banner year in 2021 or 2022, but we don't think it's going to collapse except for in some cases where things have just gotten a little euphoric.
Gotcha. Ryan, as a growth investor, are you views about the same, or are you have some other things that you want to append on to those comments?
Yeah, I think when people hear we manage concentrated portfolios in growth equities, immediately people assume risk. And then in the technology space, again, it's got a history of being quite risky, right? Because there have been booms and busts, and things work and they don't work out. And so that's really not the way we approach any sector that we invest in, let alone information technology. A good example of the way we approach the tech space would be I guess you could describe it as a picks and shovels play, where rather than being the prospector that's going out into the river panning for gold, we'd rather be the shopkeeper that's selling them the pans and the shovels and the picks, so they can go out and go search for their fortune. So one of our largest holdings and a holding we've held for over 15 years is Taiwan Semiconductor. The company has continually pumped tons of money in R&D into their business to be able to be at the leading edge of chip design and chip production. Now, they're not the ones who are actually designing the chips on their own. They're the foundry that creates the chips. And so it doesn't matter which company's chips are going in the iPhone, as long as they're being produced through Taiwan Semiconductor as a foundry, then that company is going to win in that pursuit. We found that they're actually not only winning from a market perspective, but also vis-a-vis their competitors. One of their closest competitors, Intel, just announced they've got a 12-year delay on the production of 7 nanometer chips, which are essential for high performance computing, for the Internet of Things, for 5G networks, for all the chips that are going into our cars, to our coffee machines. And so from a technology perspective, we want to see long-term tailwinds that are driving our businesses forward. We want to find businesses that are squarely in the middle of a value chain, and that are going to benefit. And we want to avoid binary risks of maybe one-trick ponies or companies that have too narrow of a potential outcome. Another top holding is Shopify. We just think that given the marketplace is dominated by Amazon.com and their singular focus is the consumer, Shopify takes a very different tact, and their singular focus is on the merchant. They want to make sure the merchant experience is delightful. So that way they take on more and more services that Shopify offers. And because it's a built out technology, there's economies of scale there, and that you can see significant margin expansion as both large and mega cap companies utilize their services to go direct to consumer, as well as the very small mom and pop shops that maybe do have small products for sale. So our information technology holdings aren't really the ones that you're going to brag about at a cocktail party, but they tend to do well over full market cycles and allow us to hold them for 5+ years apiece.
Gotcha. Great perspective. Say, Travis, we did get one question that came in over to Transom, and it's actually having to do in your bailiwick there, having to do with deficits. Concern about the deficit, and quite frankly, this, my own insert here. Is it are we at modern monetary theory now with the amount of spending that's going on? What is Western's view on deficits? Do they matter? But I kind of sense that they do somewhat, but they're not really going to be driving interest rates in the near term. Is that what your view is?
Yeah, I think certainly deficits. The problem is, we just don't know what is that level of debt to GDP where investors lose confidence. Obviously, we're in a unique position in the U.S. having the world's reserve currency, so we certainly have much more flexibility there. But that's the tricky thing, is you just don't know what that level is. I think hearing what the Fed is saying, what Yellen was discussing in her testimony as the potential Treasury Secretary, is basically saying, look, we need to generate more stimulus today. We need to make sure that we limit the depth of this recession. And if you don't act fast or increase that stimulus, you potentially risk scarring the economy for longer. And effectively saying, act big now, especially since rates are so low, and kind of worry about debt, worry about the deficit later. So that is, I think, the tack that certainly the Fed has been proposing and suggesting, and that seems to be this administration's approach as well. Again, at some point, you do have to address debt and deficits, but I think they basically said now is not the time to do that. Once we get into kind of a more robust recovery, once we get more healing in the economy, then yes, you probably address that. And certainly, I don't think any politician is looking to raise taxes in the middle of a pandemic. And obviously, given the slim majority that the Democrats have, the ability to do that is going to be limited. But that's probably a next year discussion. This year, you're talking about more stimulus, more support for the economy, and kind of worrying about deficits later. But certainly something that's on everybody's mind. And what is that level? I don't think anybody really knows, and hopefully we don't get close to that. But certainly this year is going to be more about additional support, and maybe next year, hopefully we're through a kind of a more full recovery at that point, and can look at ways of trying to address the deficits going forward.
Great. Good. Well, on that note, we've hit the top of the hour and maybe a minute or so beyond. So to be respectful of everybody who's participating, wanted to say that we can close out this webinar and thank Tim, Travis, and Ryan for contributing their time to this discussion. It's been great. Thank you, participants, for joining in and listening, and thank you for your question. And we look forward to meeting with you in the coming year, and hopefully we'll have another webinar in the next 6 months or so on another informative subject. So thanks, panelists. for joining in, and we'll be seeing you again in the future. Take care.
Thank you, John.
All right.
Thanks, John.
Yeah.